Hello and welcome everybody to The Quality Investor. With earnings season in full swing, I've been providing commentary on various businesses and their results. This is a way for me to see if my investment thesis remains intact if it is a stock that I hold. Earlier this week, financial data company MSCI, ticker MSCI, released their earnings. And as usual, it was another strong and predictable quarter for MSCI. In my view, MSCI is a nearly perfect business. It consistently compounds its earnings using a business model that runs on autopilot. They generate revenue from a subscription-based model as well as asset fees collected on the ETFs for their indexes. My investment thesis for MSCI is very simple. Point 1. MSCI is an effective monopoly since it is the global standard for benchmarking portfolio returns. Nearly every non-S&P 500 fund uses an MSCI index for benchmarking, leading to a 90% market share in the global equity index market. Point 2. They have a subscription-based and asset fee-based revenue model which drives up margins and creates predictable cash flows. Point 3. They have high switching costs for their analytics platform, which is nearly 25% of their revenue, due to the client's need to reconfigure their trading platforms and investment processes if they switch to another provider. And my final point is they reward shareholders with growing dividends and share repurchases. The monopoly part is what I really love. One of my main investment requirements is businesses with monopolistic tendencies. Think about a company like Microsoft with their operating system or Google with their internet search. These kinds of businesses are really great at compounding their earnings because they have very high barriers to entry and they have a lot of power in the markets they serve. All right, let's get into the earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can be notified as soon as I post more stock analysis content. The slide we're looking at here is their Q3 2023 segment operating revenues. And you can see they report on 4 segments: index, analytics, ESG and climate, and all other. And 3 of the 4 had very good growth year over year for the quarter. So index with a 12% growth, analytics was 6%, and then ESG and climate, their fastest growing segment, with 27%. You can also see that each of their segments is made up large part in recurring subscription revenues. That makes the revenue very easy to predict, and it's a very good way to grow a business. And then in the index segment, they have their asset-based fees revenue, and that is a lot of the ETFs they have that people invest into. They collect a small percentage of those asset fees, so they basically earn money just by existing. And that's the kind of business that I love. This next slide is strong market movement and momentum and cash flows continues. And what it's really showing here is the total assets under management of all the ETFs that MSCI operates. And what I particularly wanted to point out here was look at this yellow bar going all the way back to 2008. This is the cash inflow outflow metric here. And you can see that cash has been flowing into their ETFs on a fairly consistent basis for nearly 15 years. And they've only had one down year, and that was in 2013. So investors are coming into these funds and they're putting their money in there. They have net cash inflows and they're not taking their money out. So that means they're just collecting those asset fees every single quarter and year and so on. MSCI expects this kind of growth to continue for the long term. So here we're looking at their long-term targets, and just MSCI as a whole is expecting a revenue growth rate in the low double digits, at least 10% per year. And for their indexes, also low double digits. But like I was saying before, the ESG and climate, this is their fastest growing segment. And they expect growth in the mid to high 20s, okay, for the foreseeable future. That's incredible growth. And that ESG and climate sector, that could catch up to the size of their index reporting segment. And if they do that, they're going to be returning a lot of cash to us shareholders. So quickly, I just want to point out their income statement for the quarter. So you can see in the 3 months ended here at 11.6 growth in operating revenues, and then also a 14.1% year-over-year growth for their operating income, suggesting that they're growing their margins, which is extremely important for compounding. And in terms of rewarding the shareholder with share buybacks, you can see that's having a very nice effect on their EPS. So their earnings per diluted common share, $3.27, a 22% growth year over year. And here they're showing their operating results by segment and revenue type. So on the consolidated basis, you can see that margin growth here, that 76.7 versus 76.3 last year. It doesn't seem large, But the largest growth for their operating margins, if you look at the ESG and climate, 34.8% margin versus a 27.6 margin last year. So that ESG and climate is definitely going to be a growth driver for the long term for MSCI. So coming over to some charts here, these to me demonstrate just the phenomenal growth of this company. I mean, they virtually increased their revenue and net income every single quarter without fail. They had a slight dip here in 2022, March 2022, but then they're lowering their operating margin, their SG&A margins coming down, their operating margins coming down. And then you see that share buyback program. I mean, this company is just like clockwork. It's so predictable, and I just love a company that just grows like this every single quarter. But importantly, after updating the numbers for their Q3, is MSCI currently on sale? And right now, it doesn't look like they are. So my discounted cash flow price for them is $475.65. And they do have an incredible dividend and incredible dividend growth prospects in the future, which brings their dividend valuation model price to $752. However, they have an exit multiple of 436. It wasn't helped today because S&P Global had an earnings release and they shot up quite a bit in the market today. So that kind of pushed up their exit multiple for their comparison purposes. But other than that, I mean, if you have a 10% margin of safety in this business, the acceptable buy price for it is $441.98. My valuation average is $491.09. However, if you want that margin of safety, if you want to kind of be a little bit more risk averse and wait, then in that case, wait, because if you have some now, just hold on to it. If you want to wait for a little bit for that price to come down, and it might. I mean, you can see they had some pretty large drops over their 3-year chart here. So there are a lot of instances where MSCI gets on sale. Other than that, if you don't have much of a risk tolerance, they are a little bit under that 491 valuation average. So maybe you should pick up some shares. However, personally, I'm going to wait and hold off until they come down in price for a little bit. So before we go, I do want to emphasize that this is not financial advice, and I do own a stake in MSCI. And with that, thank you for watching today's video. And what do you think? Let me know by commenting below. I really do love the feedback. Also, please hit that like button. And if you found this info helpful, consider subscribing to the channel and joining our community. Thank you and happy investing.